So in this video, we're going to talk about ways to pay for care. As you may have seen in our previous presentation, the cost of care is rising year on year, and having your own provisions in place can provide you with a great deal of flexibility. There are many ways in which you can structure your financial plan to meet your care costs should you need to.
So as in the previous presentation, if you have more than 23,250 in savings, you are expected to fund your own care. Many clients find that their income from the pensions is not quite enough. Therefore, they will look at using their own assets to cover the difference between their income and expenditure. There's a few key ways in which you can do this,
Such as cash savings, existing investments or bonds, using your pension or using your pension pot to provide you with a guaranteed income known as an annuity, and lastly, using your property.
Now, cash such as bank accounts and savings is usually the first point of call. It's the least tax efficient and the most readily available. The downside of using your cash is that it can be depleted rather quickly, and it's really important to retain some of your cash for emergencies.
So investments can be used to generate an income, whereas previously they might have been focused on providing you with growth. This might include a general investment account or an ISA. Investment bonds are often a go-to solution where tax efficiency is required, and some providers will offer bonds specifically designed to meet care costs. However, these are few and far between in modern times. Again, we would suggest that you speak to your financial planner who will help you work out how much income you need and create what we call a cash flow forecast. Investment bonds are also generally disregarded when the local authority is assessing your funding needs, so can be a really useful safe haven for your money.
So using your pension to buy an annuity is a really great way to manage the need for a guaranteed and regular income, and some providers do offer a specific annuity that is designed to cover your care costs. This can also be another way of protecting your capital. Now, you may want to pre-plan for the cost of care, or it might be an immediate need that arises unexpectedly. There are options for this as well. The long-term care financial market is fairly limited, and as a financial planner, we take specialist qualifications before we can give you this kind of advice.
So for many people, the main asset is the family home, and there are a few ways in which you can use the value of your home to pay for care. The simplest way is to sell the home. However, this might not be possible if a family member is living there, and of course it can take time. You could also ask for a deferred payment agreement that will allow you to use your home as the asset for security, but allows you to defer the payments to any care provider. This means that you still retain the value of the home and any growth in value over the long term.
Another solution is renting out your property, which can be a great way of producing additional income. And there's also equity release to be considered, but we would only really recommend this as a last resort. Equity release can be expensive, and often the provider will give you a lower percentage of the value. Receiving the capital into your account can also affect your entitlement to state benefits, so it's important to get advice from a qualified professional.
So in reality, paying for care is extremely complex, and it's more than likely that a combination of ways to pay will be used at one time. Your financial planner will create a cash flow model for you that gives you a visual representation of your plan. We have created a cash flow model which shows a client who is self-funding care, and you're able to download a copy within the links below. Everyone's circumstances are different, and we take into account your financial, personal, and medical outlook to be able to help you see the overall picture. We ask you to involve your family in the discussions, and ultimately we try and make things as simple as possible.
Thank you.
Thanks.